Wow, I think Facebook got unfriended there. Can you unlike a stock? Well, if you can, certainly that happened to Facebook. That really rocked the market, particularly the tech sector. Hey everybody, Courtney Smith here with our weekly edition of Wall Street Winners. So happy to be here. This is so fantastic. Love making a ton of money in the marketplace. This week a little bit more challenging because of that Facebook hammer-ammo. But let's just take a look here. And oh my God, this is so fantastic. This is way better than getting friended on Facebook is to read this. So read it very closely. Okay, S&P 500. Now, after the Facebook debacle, all the market indexes were down, but really it was the Nasdaq, as we'll see here in a second, that really got hammered. But basically, S&P, we didn't even break the low of 3 days ago. So it was really a non-event. Purple predictors, okay. So the S&P looks okay. Now, look at the rhythm of the market. Look at the ups and the downs. Don't you think it's kind of time for a little bit of a down? Why not? Let's assume that the market's going to drift a little lower over the coming week and then resume its bull move. But let's take a look at the facts here. One of the facts is in the upper right-hand corner. Buying pressure remains far above selling pressure. It hooked down a little bit, but what's happening is that we're seeing money flow more into Dow 30 stocks and less into Nasdaq or small cap. You see, with there is an announcement by the EU and President Trump that they had, as some people said, they called a truce. But the main thing is that they not only called a truce on raising tariffs, they agreed that they would work towards zero tariffs. So in other words, rather than being in a trade war, they would be in a trade peace. And that's helping out those Dow 30 stocks, those S&P 500 stocks. And so money's flowing out of domestic-oriented stocks and into the big multinationals. And so we see the Dow breaking to new highs. It was up on Thursday, down on Friday, but hardly at all. Let's go back to the S&P. The S&P down a little bit on Thursday, down a little bit more on Friday. Now let's take a look at the Nasdaq. Whammo-rammo, look at that thing. It cracked to almost a 1-month low. Purple predictors collapsing. This is what I'm talking about. We don't want to be in Nasdaq type stocks anymore. We want to be in boring stocks right now. Now, seasonality, because it's the Russell 2000, this is what I'm talking about. These small cap stocks, because the trade war with Europe is over, I think we can say that, they're basically looking at this and saying, well, gosh, if it's over, then we don't need to put our money into small cap domestic stocks. Let's go back to putting it into big multinationals. Now, of course, there's still issues with other parts of the country, NAFTA and China being the two other primary ones that have to be resolved. So it's not a completely set theory that the trade war is over. Seasonality, we're supposed to be dipping. We're supposed to be dragging sideways, but we're still setting up for a great fourth quarter. Yield curve is not much very important right now because, as you can see, a year ago it was pretty stable, up around 115, 120. And lately we've seen it actually go back more positive in the last week. So it's kind of taken the pressure off the psychology of the market. Asset allocation, though, was quite interesting because here, except for the last couple of days, we saw money flowing out of the bond market and into the stock market on a massive scale. Look at that. Over the last month, in the month of July, money has been flowing out of bonds and into stocks. Our stock market RISKDICATor shows, though, that the money now, particularly in this last week, is starting to go into conservative sectors. So we're starting to see things like utilities and consumer staples stabilize, still not going up, but at least stabilizing at this point. They just don't want to take a lot of risk. This is another thing that knocks the Nasdaq sector or small cap stocks. And by the way, when we show you these things, we're the only people showing you these insights into the market. These are exclusive to us. You have to come here to get these insights into what's really going on in the market, not the hocus pocus that they give you. Okay, global shares. really, who cares? We're much better off in the U.S. market. The one place I have been suggesting is in Aussie shares. Grinding higher, not the greatest bull market. I told you to get long. You're up from where we got long, but not much. A little bit of a bull market here. Bonds, though, cracked. As we saw in the asset allocation, money was flowing out of the bond market and into the stock market. But what this means is when bonds go down, that means that interest rates are going up. Okay, going up. Purple Predictor also very negative here in the bond market. Now, the real thing that happened was the blue line. The blue line is the 10-year yield in Germany. It hooked up aggressively, and that's what really forced the 10-year Treasury here in America to move up as well. The gold line is gold. The chart itself is the CRB. So commodity prices are still saying lower interest rates, but 10-year treasuries in London, they went up, and as a result, we're seeing an increase in interest rates here as well. Now, the dollar, still in this big trading range. I kind of made it slant up a little bit, but nonetheless, it's a piece of garbage. I think the best thing to do with the U.S. dollar is to do nothing, and it's not really affecting any other market because it's not going anywhere. So as a result, it's not really affecting the bond or the stock market or anything like that. So it's just kind of sitting there being really boring. All right, so we're going to ignore it. Gold, though, that's a clear bear market. That's a clear bear market. Now, I'm not short. I should be short because it's a clear bear market. So I am looking for a reason. I'm looking for an entry place, a low-risk entry point where I can get short gold. Our indicators, though, this is interesting. In the last week, 2 of the 3 indicators started to turn more bullish. So that might get us a rally. Now, we got this stabilization over the last week, but maybe we're going to start to get a rally, maybe get us back up to 1250, 1260, something like that. Then we're going to have to reevaluate what to do at that point. Oil, this has really gone into the trading range that I'm looking at. I am getting more bullish on it, but so much hinges right now. The best thing to do with oil is to stand aside because we know what the Americans are going to do. They're going to pump a lot more oil. We know that demand is going to go up. We know that. But what we don't know is what the Saudis are going to do. They've been talking different angles each week. And Bitcoin had this nice rally from like 5,800 to 8,800. Purple Predictor still a little bit bullish. You can see we've squeezed in that blue band is the 55-day channel. I'm just going to trade Bitcoin whichever way it breaks out. If it breaks out of the top, I'm going to get long. If it breaks out of the bottom, I'm going to get short. So at 88.47 is the top of the channel. 58.03 is the bottom. Put your orders in, let's say 88.50 and let's say 57.99. That should be the trade. Keep a very tight stop. Okay, keep a tight stop here. All right, all you freebies, of course you should sign up for every class we do. It's really the most cool thing that you can possibly do. But check these out. Go to CourtneySmith.com or WealthBuilderLLC.com to get all the details of all these events. And of course, we get all our great stock ideas, individual stock ideas, which fully paid up members get from StockButler.com. So check it out because it's a great, great tool to have. All right, everybody. Thank you, freebies, fully paid up members. Hang in there. Got some really interesting things have happened here that I want to show you.